If you have little to no experience about how to start your investment journey in your 20s, 30s, or even in your teens, today's episode is made for you. On today's episode of a Student Investor Podcast, guys, I'm trying to simplify the world of investing, the concepts, strategies, and terms used there so that every young person in their 20s or 30s or even their teens can be able to start investment. We need to open up the space of investing, and today's episode is all about that. Simplifying every term, simplifying every concept, simplifying every strategy used there. So guys, without wasting any time, let's get into this episode. Welcome to the Student Investor Podcast with Ivan Sambo, the podcast that focuses on starting a conversation about money, investing, growing your career, and being a young person in South Africa. Our goal is to simplify the conversation so that we can all learn and grow as young people in South Africa. Hello, future millionaires and billionaires. I love saying that, guys. I repeat, I love saying that because this podcast is all about that. Creating wealth so that all we can be the millionaires or billionaires or whatever status that you want to achieve, we can be able to achieve it through understanding the world of money. Because money is the exchange and expression of human. Basically, we express ourselves through money. Everything we do through money. It is a form of communication. So today's episode, as is titled, How to Start Your Investment Journey in Your 20s, 30s. And I'm picking that title specifically because I believe as young people we feel threatened by the topic of how exactly do we start investing. I know at one point in my life when I wanted to do or invest in a specific a market, like for example the first time I wanted to go invest in the New York stock market, I felt threatened because majority of the people I was following on YouTube were using big terms and I felt confused, like what the hell are they talking about? So today's episode I want to simplify all of that. So first of all, I'll be talking about what you need to do before starting your investment journey. Number two, I will be walking you guys through the terms, concepts, and strategies of investment. And number three, I'll be giving you practical ways on how you as a young person in South Africa, you can start investment. And guys, I spent about 4 hours today doing research, picking up my phone, FaceTiming some few of my friends, calling few of my friends so that they can ensure what I'm saying is correct and is into the point, so that we can all learn from today's podcast in the simplest way that even a child in grade 2 can understand. So let's get into the first point of today's podcast: what to do before you start investing as a young person. There are 3 things I want to touch on that you need, I believe every young person before they start investing need to do. I want to touch on the first one. I'm a hardcore believer on the first one, which is the idea of an emergency savings account. So what exactly is that? An emergency savings account, guys, is an account that you create and set aside in a savings account with a specific banking institution for cases of emergency. Because you cannot go to the world of investing and invest your money without having a form of a safety net, that if something goes wrong, you use that safety net without going to take your money that's in your investment, because you are investing for a long term. Investment by its logic, by its nature, is for long term wealth. So for example, if you start investing today, you need a safety net that if something goes wrong in your life, you go get the money that's in your safety net. You don't go to get the money that's in your investment. So how exactly do you create an emergency savings account? Let me share my story of how I first created mine. The first one I ever created was with Standard Bank. I opened a 32-day notice account, which was wrong. It was wrong by that time. I thought it was the best way to do it because it had a good interest rate. So for me, I first started by opening a 32 notice account with Standard Bank, and I deposited, I think it was 500 rand there. And my goal that time, because I was a NSFAS student, was to at least have 3,000 there, because that time I think NSFAS was giving us 1.5 per month. So I wanted to have at least 2 months of my NSFAS allowance covered and saved in a notice account with Standard Bank. So when something goes wrong in my life, I go take that money from that account with good interest rates. When a notice account had a good interest rate, I go get my money there and I use that money for emergency instead of going to Easy Equity and withdraw my investment. So that's how I first created mine. But I made the mistake in my beginning of putting my emergency savings account in a notice account instead of putting it in a easy access account where you can get immediately, because when an emergency pops up, I don't have 32 days to wait. So that's the best way to create your emergency savings account. Create it in an account that you know can get good interest rate, but at the same time being able to have easy access to your money when an emergency happens. So that's the first thing that, guys, you need to ensure before you start investing. You have an emergency savings account. Number 2, guys, debt. You need to ensure you reduce your debt before you start your investment journey. You can keep on investing while also reducing your debt, putting more money in paying off your debt than actually investing, because it doesn't make logical sense for you to start your investment journey while you still owe Truworths a lot of money, you still owe Edgar's a lot of money, you owe TFG a lot of money. The interest rate from those debts that you have is higher than the money you will be making from those investments. So basically you are working on a loss, and investment for you now will feel like a hard thing to do, because every single month you need to take money and invest it and take money to pay debt. So it's better off firstly you focus on reducing your debt and make sure your debt is at the lowest point possible, so you can have more money to invest, and then you don't have to worry about the high interest rate of your loans and your debt that you have to pay. Because I know clothing account now are going like 22 or 21% interest, so that's too much money going to pay debt, so that you can use that money to invest. So ensure that you reduce your debt as much as possible before starting your investment journey. I know as young people we have a lot of clothing accounts, we have cell phone contracts, we have this and that and that. Try to reduce all of that so you can have enough money to put on your investment every single month. The third thing that I want us as well as young people to think about before we start investing as well is the idea of retirement as well. Listen to me, guys. I know we are young, but having a retirement plan as well, and retirement, I knew it, whatever the case may be that works for you, is something that you also need to think about before thinking of investing, because retirement is something that one day you'll have to deal with. It's better to start now, so that when you reach retirement and the age of retirement, you have more money on your retirement and you've gained a lot of interest there as well. But I will make a separate episode to deal with emergency savings account, as well as how to deal with that and also retirement for young people. I will make another episode to deal with that alone. But now let's start into explaining some few terms around investing. But before we do that, guys, please note that none of this I'm saying constitutes as financial advice, but it's only for educational purposes. So now let's get into the basic concepts and terms used in the investment space. And I want to start by 2 terms that are used the most in the investment space that confuses a lot of young people in South Africa. The first one is shares and stocks. What are the difference between the two? Because much of people hear them like, I'm in the stock investment, I own stocks of 1, 2, 3. I'm into shares investment, I own shares of 1, 2, 3. What is the difference between the two? So guys, when someone says stock, a stock is the actual asset that you're investing into, right? So a company has a thing called a stock, and when you invest in any exchange platform, you are investing into a stock. That's the actual asset. Then shares is the unit of measurement for that stock, for that asset basically. So the stock is the asset, and shares is what is used, or the unit used to measure the stocks. So if someone says I invest into stocks of Capitec and I have 5 shares of those stocks, You see, I hope you now understand the difference between the two. So basically, sometimes those two things can be used interchangeably, but basically they mean one and the same thing. So don't get confused. Someone say, hey, I'm a stock investor. Then 2 minutes later, you hear someone say, hey, I'm a shares investor. Basically, those two people are saying one and the same thing. You can basically interchange those words to mean one and the same thing. But the technical definition of that, the stock is the actual asset, and shares are the unit to measure that assets. Basically, I hope you understand, guys. So, and when we talk about the stock market, we are talking about the place where all the actual stocks, the actual assets are listed, and you can go there and buy and sell them. Like the GSE, this is the stock market. Is where the assets, which is the stock, is listed, and people can actually go there to buy that asset, which is the stock. And a unit of measurement for a stock is shares. So I have 5 shares of stocks of Capitec, which I bought in the Johannesburg stock market, or the Johannesburg Stock Exchange, if that makes sense. So now let's talk about another concept of another term that will be thrown around a lot in the duration of this podcast series, which is ETFs, exchange traded funds. What are ETF? When we talk about ETFs, what exactly are we talking about? And when we talk about index funds, what are we talking about? I always like to say, if you hear someone saying index funds and someone say exchange traded funds, they are talking about one the same thing. Yes, there's some technical difference between the two, but in the general sense, those two things are the same. Basically, both of them are what we call a basket of assets. That asset can be stocks, those assets can be bonds. I'll define bonds later. Those assets can be commodities. I have a podcast episode which I record about commodities. You can go listen to that one. You can understand commodities better. It can be different assets which are in a basket, and that basket is the exchange traded fund itself, or is the index fund itself. For example, in South Africa, we have what we call the JSE Top 40 ETF. Basically, the JSE Top 40 ETF is a basket that has shares or stocks of all the top 40 biggest companies in the GSE. They're in one basket, and when you buy that basket, you're buying an ETF that has all those shares, right? And an index fund, basically, you can say we have an index fund that tracks the top 40 companies in the GSE. So basically, that index fund follows how are they trading all those top 40 companies, how are they performing, and that's the index fund. And sometimes an exchange traded funds can be categorized into 2 ways, right? You can have an exchange traded fund that's actively managed, and you can have an exchange traded fund that's passively managed. So when you go to the GSE, you find the GSE Top 40 ETF that's actively managed. It means that there's some people, a group of individuals, that every day sit down and manage that ETF, that basket. So okay, now this morning, what do you call this thing? ShopRite is out of the top 40. Now we might need to put what Mr. Price into the top 40. Okay, in the afternoon, no, Anglo American has fallen from the top 4. Now you need to remove Anglo American. Those are people who work every day to manage this basket that has all the top 40 companies in the ETF, right? So we call that an actively managed exchange traded fund. So then we have what we call a passively managed exchange traded fund. This one is basically the group of people who are fund manager, whoever they are, sit down and they say, okay, we have this ETF, we're calling it the Johannesburg Top 40 ETF. We have this top 40 companies there, we let it be, people can buy shares of it, and then they check in maybe once every 3 months or once every month to see if everything is a working according. But after they just leave it and they check it like once in a while. That's a passively managed ETF. So what happens in actively managed one ETF, an actively managed index, tends to be more expensive as compared to a passively managed ETF, because the actively managed ETF, there's some people every single day who check up on it, while the passively managed one, people come to check about it once every single month. A majority of retail investors or majority of investors love a passively managed ETF because it's cheaper, and majority of the time it is readjust once every month month or once every 2 months or once every quarter, so they didn't have that much of a differences than the actively managed one. So those are ETFs and exchange that's our ETF, which are exchange traded funds and index funds. I hope you understand that. Another thing that we need to explain is bond investment. Basically, when you invest in bonds, guys, you are not owning an asset, but you are borrowing your money to a private company, or you're borrowing your money to the government. So bonds is you buying debt, if I can put it like that. The government will say, hey, we are looking to borrow money from the general public. In return, we pay them interest of 1, 2, 3, 4, 5. And when you take your money, you buy that debt. So you're giving your money, you're loaning your money to government, or you're loaning your money to a private company. And we call that what you're doing, buying a bond, buying debt, if I can put it in that term. So when we talk about bond investment, we're talking about people who borrow their money, take their money and borrow it into companies, private companies or governments or public listed companies. There are some ETF that are dealing with bond. Basically ETF, a basket that has bonds only. So when you buy shares of that basket or buy shares of ETF or that index, you are buying debt. So basically you hope that you are borrowing that money to this private company or this government, and in return when they pay it back with interest, and you make money in that way. I know some other technicalities of it where you can buy debt and resell that debt to another person that wants to buy debt with the hope that the value of the debt will go up like that. That's a more technical thing. I think I'll have another episodes to deal with it alone. Another concept that we should deal about is exchange. It's not exchange trade fund, but it's a tax-free savings account. They say don't be fooled by the savings account word there. A tax-free savings account is actually an investment vehicle. So what happens is that government gives you up to 36,000 rand per year to invest without paying tax. So in your lifetime you are given 500,000 rand, which is up to 15 years to invest without paying tax. So everything you earn, all the dividends that you get there, the capital gain you get there, all of those things you don't pay tax into it. Now let's get into another concept of investing, which is how do you make money when you invest as a young person in South Africa. There are 2 ways you can make money. There are actually 3, but the third one I won't touch on it for this episode because it's all about simplicity and getting everyone into investing and without confusing them. So there are 2 ways you earn money. The first one, what we call capital gain. This is my favorite. I'm a capital gain investor, guys. I invest for capital gain. So when we talk about capital gain, so when we buy shares of Standard Bank, for example, you buy them at 10 rand in January, and in June those shares of Standard Bank you bought for 10 rand, they're at the value of 15 rand now, and you sell them in June for 15 rand, meaning you've seen a capital gain of 5 rand and you've made a profit of 5 rand. That is what we call capital gain investors. I am that form of investor. I invest for capital gain. I love it. The second way to earn money as an investor is through what we call dividends. Dividend is when you buy shares of Standard Bank for 10 rand, and Standard Bank in July comes out and say, hey Ivan, we love that you invest into us. As Standard Bank, we have made profits. For every 10 rand share that you own, we are gonna give you 1 rand back as dividend to appreciate you for investing into this company, and this company has made profits, right? So that 1 rand you get from Standard Bank for investing 10 rand for every 10 rand share that you have is what we call dividends. So those are the 2 typical ways that you earn money from investing, is through capital gain, which I explained is when you buy the share for 10 rand and it increased to 15 rand, and you started at 15 rand and you made a profit of 5 rand. That 5 rand is called capital gain. And the second way is through dividends, where you buy a share of Standard Bank for 10 rand. Then in July, the board of directors of Standard Bank come out and say, we have made a lot of profit and we'll give you a share of profit for every 10 rand share you have. We want to give you 1 rand. So if you have 100 rand share, you have shares worth 100 rand, it means you have 10 rand, 10 rand, 10 rand, 10 rand. If you have 10 of them, you're gonna get 10 rand back as dividends in that quarter. Sometimes those dividends can be paid once every year, or paid quarterly, or paid twice per year. It's based on a decision of the directors of how and they want to pay out dividends. And do remember, guys, not every company listed in the JSE will pay out dividends. So you need to do your research on which company in the JSE, New York stock market, Australian stock market pays out dividends. So I hope those concepts made investment, you can understand how investment work. So how do you start your investment journey? Now you understand the concept, you understand the ideas. How do you start your investment journey? When you start it, you need to do one thing, guys. Understand the type of investor that you are. I did mention I am a capital gain investor, right? The reason I'm a capital gain investor is because I understand the type of investor that I am. I'm young, I have no child, I have no dog, I have no form of responsibility in my life. I'm able to take more risk with my money. So I invest into companies that I see are futuristic in nature, they're innovative. So imagine they may not pay me dividend now, but I believe that their stock will be at way higher price in the next 10 years, right? So I'm a capital gain investor. That's a moderate to high risk taker in terms of my money. So it means I am that type of investor. So when I invest, I look into companies that fit that profile of who I am, because I understand the level of risk I can take. So for you as a young person in your 20s, 30s, or whatever age you are, you need to also sit down and say, what type of investor am I? Am I a high risk taker? Am I a low risk taker? Am I a moderate risk taker? And what type of investment do I do? I do dividends investments, or I do capital gain investments, or when I want to split it, or 50% gains, capital gain, 50% dividends investments, or whatever. You need to understand what formula work for you. You don't even need to make it 50-50 or one or another. You can even say 30% capital gain, 30% capital gain, 70% dividend stock, or whatever the case may be. You need to tailor-made because you need to understand what type of investor you are. So when you invest with that strategy of yours. And guys, when you talk about strategies, don't confuse yourself about strategies trying to be all this advanced complicit strategy. When you talk about strategy, when you're starting up, you just understand the form of investor that you are and how you invest about that. Then later on, you can then start to think more depth about your investment strategy. I hope that's helpful. So now you already know all those concepts, you already know all those terms. How exactly do you start? Is someone who's never invested before, or someone who's invested but has made a mistake, you try to correct yourself? I made the mistake when I started investing by buying individual companies first and making so much of a loss that when I started researching more deeper, I already lost so much money in the beginning because I put all my money into individual companies I did not fully understand. So what is typically recommended in general, that when you are starting investing, you're not fully comfortable, not fully understanding how to do your own research, exchange traded funds are the best way to start your investment, because exchange traded funds are diversified. And we say something's diversified, it means it is spread out their risk that is hard for you to make a loss. Because exchange traded funds are a basket, it means that when you are investing and you're starting an investment, you're not fully aware about to do your research, you're trying to understand everything about your investment strategy, investment profile, the type of investor that you are. You can start off by putting your money into exchange traded funds so that you don't lose so much. And as you go along and you start to discover what form of investor that you are, you can start buying individual companies. You can start now putting your money into ShopRite, Capitec Bank, buying Mr. Price, buying Anglo American, buying PPC cement, whatever the case may be. Only then you can start doing that. So it's always recommended when you start investing in your 20s and you're not sure what type of investor you are, look into exchange traded funds, look into understanding them and buy them. And as you go along, you can improve and go into buying individual companies. Here's another thing as well, we as young people to take into account when you invest as well, is fees. So also look into the fees, number one, of the broker that you'll be using. If you'll be using Shift by Standard Bank, using FNB 0, or you're going to be using Easy Equity, whatever platform you'll be using, look at their fees, guys. Fees are important because they will, over the years that you'll be investing on a platform, because it's hard to change. If a young person starts investing with Shift by Standard Bank or with Easy Equity, it's hard for them to move to another platform. It's more likely to build loyalty to that brand, that even later on you see that their fees are too much, but you're not going to change because you have built a level of loyalty to them. It's typical. You just run away from it. It's typically what happens. So before you start as well, look into the fees of the platform that you will be using. If it's Easy Equity, start their fees, understand the fees that you're going to be paying by investing with them, because they're not for free. If you are investing with Shift by Standard Bank, understand them. If it's Zero by FNB, understand them. Whatever the case may be, understand your broker's fee. And if you buy ETFs as well, ETFs also comes with their own fee, separate from the fees of the brokerage platform. So also understand the fees that you'll be paying for exchange traded funds. I always say if it's under 0.1%, it's okay. It cannot be like 1%, 3%. No, it must be like point something percent. If it's 0 point something percent, I always say it's good. But also you need to understand yourself and say you're comfortable with that as well. Another thing as well, guys, I forgot to mention, when it comes to your tax-free savings account, I say for your lifetime you're given 50. Oh, it's not 50, sorry. We're given $500,000 to invest, which is going to invest over a period of 15 years, and it's 36,000 Rand per year. If you go above that 36,000 Rand per year, you will be taxed 40% of that money above. For example, let's say you invest, you're supposed to invest 36,000 Rand, but when you invested 40,000 Rand, that 4,000 Rand left on top, government will take 40% of it and keep it for themselves as punishment for you for going above the fee they have set for you. So that are the basics of how you can start investing in your 20s, in your 30s, or even in your teens as a young South African. Tell me what you think about today's podcast. Did you enjoy it? Did you love it? And let me know through my social media platform what more you want to see from the Student Investor podcast as we continue this conversation, opening up the world of investing for young South Africans. I hope the conversation was inspiring and will lead you to take action. As always, I love hearing your thoughts. So what was your takeaway point from the conversation? Let me know on Instagram, Twitter, or Facebook. I am Ivan Sambo in all those platforms. Tag me, follow me there, and let's continue the conversation. As always, I am Ivan Sambo, your student investor, and thank you so much for listening.